Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, March 30th, 2020. I'd like to start out with a quick overview on the short-term charts. This isn't really anything that I hadn't posted all day today. Same thing, but I do want to look at a few things there, some of the things that prompted or aided the rally, or even warned of its possibility today. But then I want to spend the bulk of this video, and it won't go super long, but I do want to spend some time talking on the long-term outlook, the bigger picture, what's shaping how I'm viewing and trading this market, the trade ideas that are coming out, and what will continue to shape that going forward. In other words, if you're going to swing or trend trade this market, you have to pick a team. You have to pick a side. Are you of the mindset that we are in a bear market? That the drop over the last couple months and this subsequent rally that we've had in the last couple weeks here this has just been a bear market rally in the start of a much larger bear market, I should say, with more downside to come? Or are you of the mindset that the drop over the last couple months due to coronavirus was just a great buying opportunity? The market overreacted. Economy is strong, or will be strong and on solid footing, and will shake this off, or government stimulus, or the Fed, or whatever your reasoning. This market is going back to new highs anytime soon, and so therefore, that will help you, and it helps me determine, when we look at these rallies, these up days, are they an opportunity to short or to get out of longs? Or are they, if you are bullish and long, are you waiting for breakouts and pullbacks to support to add more? In other words, what I'm trying to say, are you looking to buy the dips? Because if you believe we're in a bullish trend, you look to buy dips to support and then sell the rips, or just hold tight. Or you're looking to short the rips and then cover on the dips, which is active trader stuff for bear market. Or if you're a swing trader, maybe kind of you sat back and waited to scale back in, believing this was a bear market rally, which we've had a couple opportunities, and preparing to swing the next leg down. So you guys know my thoughts. I added another short trade today, and I'm going to touch on that one briefly in this video. But I do believe that coverage of the semiconductor sector warrants a whole separate video. Look at all the different three main semiconductor ETFs that are out there, not including the leveraged ones. There's 3 of them: SOXX, XSD, and SMH. They track 3 different semiconductor sectors, and then of course the leading stocks. That's how I think thorough analysis on a sector includes looking at at least the largest components in that sector to determine where the whole sector is headed, whether it's confirming any bullish or bearish developments that I see in the ETF chart. Sometimes you'll see a chart of a sector and this one looks bullish, but then I dig down, and if a handful or most of the top components in that sector are telling me a different story, or the charts aren't that clear, I take a step back. Okay, let's dig into the charts now. Long term or short term, we're on the 60-minute QQQ chart. This is an after hours chart, so when you're going to see sometimes these wonky little candles here, don't know why. It's not only TC2000. A lot of charting platforms do that. This was not a trade right here. This long candle. This is where we're at. If you're ever in doubt, just sometimes, well, you'll see it there. You can see this is where trading occurred down here. Sometimes you'll get these spikes, and it may be legit if the chart services show it. That's why some people don't realize what they're doing when they're trading after hour session, if they allow a trade to be open and filled. Because if you put a buy or sell order up here at 196, and after hours you can only trade limit orders. You can't do market orders. And someone sees it up there, they might want to fill it. So to put a sell order right there, I don't know why it would be, and again, I won't explain too much, but it's just that's not where the trade. There must have been a single trade right there, and it wasn't with the rest of the trades. It wasn't where we were trading. So I need to explain that. So when we look at these charts, when you see these gray areas here that are showing the after hours trades, you need to disregard. These are common to see these long candlestick shadows, that skinny part. So again, you can verify it. Time and sales is another way to see what happened. All right. So what happened today? Well, nothing much. We basically pushed back right to that T3 level. You can see a high today of 192.49, a little shy of that 192.72. As I talked about earlier today in the update this morning, I showed, let's take a look at that real quick. That was right here. It did an update showing that we could run in for a back test of the trend lines. This was ES right here, and I'll show you why, what the catalyst was, among other things. But so we ran up there, and that's exactly what we did. That's ES. I did the same thing for NQ. Again, these were in pre-market today right here. And back test there of the trend line, and we'll get to those in 1 second. That's NQ, the NASDAQ 100 futures. And then going back to these on QQQ and SPY. This is not the official trade. The official trade is right here, the board on the official trade. So that stop wasn't hit again. This is, and I only include the regular session trades anyways, on as far as the targets and the stop parameters. Although I do suggest that if you are trading in this volatile market and you have a price target that you want to be filled at and get out of that trade, do the checkbox with your broker's order. Have a good to cancel, let's say buy to cover order on QQQ at 172.80 and allow it to be filled. Again, if that's your final target, I may extend the targets on this trade, but to show you what happened is we essentially have negative divergence right now, because you can see as I zoom in real tight here, although technically we don't because we didn't make a higher high. Let me grab this tool down here, change this color. See right there, this is how high we went. It's slightly less than horizontal. If that line was right there, then we'd technically have that extension of the negative divergence. But for all intents and purposes, you're talking a couple pennies, because we were a couple pennies shy of that target. Remember on Friday we hit my on the other board that high was the exact target there, 192.72, and I told you we went as high today before the close of 192.49. So I'm going to call that negative divergence, and I'm also going to say this, that we could certainly pop in the morning. As long as it's a relatively small pop and drop, it would be nice clean divergence. I'm talking about this negative divergence down here. We had divergence last on Friday when we added that short trade, and what we did today, we just came back for a near back test of that level and simply extended the divergence. What does that mean to me? Well, it was a small divergent high on Friday. Now it's a bigger divergent high, and you get pretty big divergence. It's not as big as that positive divergence there, but this was a divergent low in a bear market, and it played out for this. This is a divergent high in a bear market right now, and that could lead to a much, much larger drop. I'm going to get to the long-term charts here in a second and tell you why, or at least reiterate why I'm very much open to allowing this one morph into a runner trade and extending the targets as we did on our previous QQQ short trade after the market started to fall. All right, so that's it. In a nutshell, it looks good to me. PPO is starting to turn down right here, poised to make a bearish crossover, confirming the divergence. Remember, it's just my technicality, what I like to say. Negative divergence is confirmed when you have a lower peak in the RSI or PPO right here, I should say the PPO, and that effectively puts in then a lower high. In this case, we'll have a series of lower highs right there as prices make equal or higher highs. Alrighty, SPY, already covered that. Same story, I believe I did. If not, here it is. That's what SPY looks like. You can see here's your divergence line, and SPY might have same story. Let's see what was Friday's high. I'm probably splitting hairs here. It's not that important when you're talking a few pennies. 262.80, and before the close today, that's that candle we hit a high of 262.43. So again, same thing. Pop in the morning as long as we don't go too much higher. If you go too much higher, then you have the potential to take these divergences out. So as of now, I still very much favor that. And now we'll look at the futures. Let's see, here we go. All right, so that is that same chart I just showed you in the pre-market session. Here, we'll go back to it right here and right here. No, that was ES. Well, same story, ES. Well, there's a scenario, and again, I'm going to get to what prompted this or warned of it today. And there's NQ right there showing you. And I made my thoughts pretty clear. I didn't have very strong convictions on where we're going to go today. And once those Treasury bonds and the dollar broke out and broke down, that furthered or further increased the chances for a bounce in the fact that this bullish scenario would play out. We go into back test. So that's that, and there it is on ES. Same story. I mean, a perfect back test. I haven't even touched that trend line since this morning, and you can see right there that candle, that last candle of the day, looks like boom, just kissed it there, and maybe a little minor trend line setting up here to watch like this, or price channel down below the main trend line. But this is TA 101. Sometimes you break down and never look back. Sometimes you break down below a trend line and then back test it. So we've had one and now two back tests. Here's your trend line again. That's why it's white. It's the primary. It's the most important trend line. It comes off the recent lows. And then you had in those charts, again, posted this morning, we were right here. You had a downtrend line, minor downtrend line. So when you pop the minor downtrend line, that in itself was a catalyst, technical, short-term trend line, minor trend line, but it was a catalyst for this. And this is what I expect now. And you can see here, same story on ES. We're slightly below the previous highs from Friday right there. So if ES can come up a little bit more or that, we have divergence. But look, divergence is not a be-all, end-all. It's close enough. It's telling us the momentum is lagging on this move up. That's what it's telling us. These are momentum indicators. And, you know, we can still make it all the way up here, possibly that 2696 target or resistance level, and still have the divergence in place. So that's something to watch. And again, we'll go home. I'm a little more confident right now that we'll turn around tomorrow, but there might be a little more upside. And again, I'm going to show you right now what to look for on that. So let's just say I'm not, highly confident we go right down from here. But again, I am highly confident that we reverse somewhere within this zone and then start another leg down to go on to hit T2 and at least T2 and quite likely T3 on that QQQ short trade, and maybe more. We'll just see how things go from there. So that was ES. And that was NQ, same thing, back testing right there, looking for it to roll over, looking at a potential trend line right here, and break of that trend line. First off, we need to look for a rejection off this level. When you back test, you can continue to back test. So what you want to see is a red candle off there, whether it comes at a higher level or not. Or sometimes you'll start to roll over slowly and then get a big red candle. And that's where traders realize, okay, the back test failed. We're going down. The next leg down is about to be underway. Okay, so now to the catalyst of the rally, and what had me giving you the kind of split scenarios here is right here. Scroll down this morning at Treasury bonds. And so what I had said here is ZB. This Treasury bonds were looking poised for a pullback. And although it is possible to see bonds drop in the stock market rally, it's unlikely. Treasury bonds tend to go up when the stock market's correcting, when investors are worried. Sometimes they'll move up in anticipation in advance, but let's keep it simple. Here's what was shown this morning. Nice clean price channel with a nice, very well defined, super well defined. Look how many tags on that. Although it's a minor uptrend line within the channel, again, it was well defined. And so that was it. We broke that. That was a sell signal right there, and then you had price support here at 179.289. And so again, as I said in that post this morning, this would likely be the catalyst or coincide with a rally in the stock market, if not the sole catalyst, if you will. Again, the stock market at the same time broke out of its minor downtrend line that I showed you on the futures a minute ago. So stuff is not, they're not mere coincidences that these trend lines and all that coming together. So that's what happened there. So now let's look at CB, what happened after this morning. There it is. So we broke down, and interesting, look what happened since. So there's our sell signal. By the way, we had a little divergent high there, actually big divergence on the PPO, smaller divergence then set up on the RSI as I marked right here. So this gives us right here, again, we're looking at ZB, the 10-year Treasury bond futures. I know I talk fast as I go through these charts, but this is comparable to TLT, except it's going to paint a little better picture when we look at the futures because we can see the round-the-clock trades. We don't see those on TLT because TLT is an ETF. So boom, there was your breakdown. We fell right to that support. We had what I call a momentum fueled overshoot. You see that skinny part, the white part of this candle, that's the candlestick shadow. It means we briefly dipped down. In fact, if I see this trend line right here, if I extend this trend line that I already had on there, that's what came in and caught it right there. So we came down, hit that trend line because we had that kind of wedge type pattern. But then the 60-minute candle failed to close down below. In other words, it was a momentum fueled overshoot. Look at that. We parked right there. Same place that red candle parked. We got back above the 179, 289 level. So where am I going with that? That could be it. That's a rejection off the top of the channel. Remember, these were the most probably the most salient levels here. These two lines, because there's this horizontal or slightly ascending price channel going on ZB. Treasury bonds are walking up. However, we did break. We were rejected off the top. We had a little wedge overshoot with that bearish rising wedge. So where I'm going with this tomorrow, should we tonight and into tomorrow move lower, break below that 179, 289 level and keep going, then look for support right here. And then what would happen if this scenario plays out? And we're not talking big amounts. I'm not giving you these opposing scenarios where the market's going to go up 10% or down 10%. These are micro levels. In other words, I'm confident enough to be short right here to say, look, the most probable scenario, if we do go down, the market goes up a little more, treasuries would go down a little more and most likely find support here and bounce off the bottom of this channel. And that would mean when treasuries start to rally, then the stock market will most likely start to drop, and that could be the reversal, the end point. This would coincide with a small pop in the morning, maybe even in the pre-market session to give us those divergent highs, slightly higher highs, take out Friday's highs in the stock market. SPY and QQQ and NQ and ES, followed by a reversal. So that's what I'm looking for. And then keep in mind, the blue lines define the channel. That's a pretty significant channel. A bigger drop would most likely, but not necessarily, be bullish for stock market. I don't want to sound too confusing here, but I've already given you my concerns with treasury bonds. Pretty much, basically, the U.S. is issuing too darn many of them. Gold is valuable because it's scarce, but all of a sudden, if let's say we had an eruption, volcano somewhere, blew open and it spewed out billions of tons of gold, and gold was just flying everywhere. It was melting down rivers, and it spewed it all over the earth, and everybody had pounds and pounds of gold nuggets landing in their yard. Guess what? Gold's not going to be so valuable anymore. So in treasury bonds, the government has been going to continue to issue a lot of these, and so therefore it's going to distort the normal relationship between stocks and bonds, and it already has. We've already started to see that. We saw bonds selling off here while stocks were correcting during a good part of that. So let me just say, right now everything's normalized, and we're not in that forced liquidation mode. So, but so this is working well, that relationship, but it could break later on, and I think at some point it probably will. But until then, let's just use this as just a guide to help us guide. We're not trading. I don't have an official trade on CB. You could have traded it today if you're an active trader, but again, it's working well right now with the stock market, so this is what we'll watch for. And then again, what I was getting at is ultimately a break above or below this channel could be bullish or bearish for treasury bonds and tell us something what's going on with the stocks or the stock market. And then back to that post from this morning, that was ZB. Remember, ZB is a 30-year long bond. ZN is the 10-year treasury bond, and this one was even more clear. This was a beautiful chart to me. Right now, I think people are probably shying away from the 30-year. Who wants to lock their money up next to nothing for 30 years? It's bad enough to do it for 10 years. So here's the 10-year bond. It has a very clean chart. Nice, well-defined resistance at 139.075 right there. And then this, just like ZB that we just looked at, a very clean, well-defined uptrend line, and just like ZB, a nice, clean price channel. And so that's it. I said break of the minor uptrend line, likely to spark a correction back down to the bottom of the channel and or that 137.022 support right there below. Again, that was this morning, and I'm spending all this time on treasury bonds because they are, like I said, it did help to that's not the right chart. Let me find ZN. It should be at one of these over here. Yep, there it is, ZN. All right. And so again, it coincided with the breakout in stocks when treasury bonds broke down. And again, it was also indicated that it would probably happen here with these negative divergences. So it wasn't just a random trend line break. We had the uptrend line, the minor trend line within the price channel, and we had that breakdown. So where it goes from here, whether it goes to the bottom of the channel or not, hard to say, but that's the most likely scenario now that the channel's been broke. Maybe we go hit the top again, then go down, but we'll watch that. So you can see those are some key levels to watch for you bond traders, and that's it. Let's keep an eye on that for tomorrow. Okay, right at the 20-minute mark. It's 20 minutes of talking about the short term. The long term, I will not spend 20 minutes. I'm just going to show you these charts. We'll keep it very simple. We're not going to look at them all. I'm going to look at the right here, starting with the monthly charts. Believe it or not, QQQ, at least according to two, not all, but two of my most trusted, we'll call them, or simple but effective trend indicators, QQQ is still holding. It's still in a bull market, despite how much it dropped. Again, I told you that I laugh at the media's antiquated definition of a bull and bear market. It should be measured something more of a retracement of a previous move. When you look at this, there's QQQ by all metrics other than the definition of a drop of 20% or more. Get used to 20% drops and rallies within the next bear market, because you're gonna, like I said, we've already, according to the media, in the last several weeks here, we've gone from a bear market, just the last 2 weeks, bear market to a bull market, and I guess if we drop soon, they'll say we're back in a bear market. So either way, what we're looking at here, this is a monthly chart of QQQ. I know I've covered this many times. 20-month exponential moving average gets us a 10 on a scale 1 to 10 for being not just that accurate of an indicator, but when you come to simplicity, it doesn't get any simpler than a single moving average defining bull and bear trends in the market. And works on SPY, works on QQQ, works on a lot of stocks and sectors. But you can see here's our Super Bowl up into the time, longest and strongest up and before this one came along, and it just did a phenomenal job defining it, meaning that it acts as support when you pull back, and as long as prices are above that, you're in a bull market. Then you drop below it, you're in a bear market, and when you're in the bear market, you're below it. Then you recover it, you're in a bull market, and this was a bull market here from 2003 to 2007. Then you drop below it, and you're in a bear market, okay, and above it. So simple, again, and effective, and look where we are. Tomorrow will be the end of the month. Anything that happens between intramonth, it doesn't mean it make a difference here. You can have these intramonth breaks as long as you close back relatively close to it or back above it, like you did back here in 2015 and we did back here in 2016. You had a lot of breaks back here in 2016. But again, monthly charts, you're using a monthly candlestick. All that matters is where that candle closes, and a lot can happen, and often does, in a 30-day period. So tomorrow we close, and we'll see where we close. Now, we'd have to have a hell of a drop to print a solid close. And now, does this mean that I want to go long, loading all my money into QQQ and everything else I can buy for the next leg up in the bull market? No, not at all. It's just, I'm just showing you one about the only sector right now, or index that I should say. And of all the indexes, I've talked about this often. I like QQQ. I like to trade it. It's full of tech stocks. It's more concentrated, which makes it more tradable than the S&P 500 because you have almost 50% of the weightings tech stocks. You don't have financials, or almost an insignificant amount, 0.3%, so they're not going to move the needle. Whereas when you go long or short the S&P 500 via SPY, you're shorting 500 of the strongest, best companies out there, maybe defensive stocks right now, utilities, Procter & Gamble, things that might be holding up in this market, Amazon, and you're also then going long the 100, whatever I said. If I went short, you're going long the 100 strongest, and you're also shorting the weakest. So you're shorting a diluted pool, a lot canceling each other out. So QQQ is more of a direct play. If you're trading a sector, you get it right, it tends to go up more, and when you get the short trades right, it tends to go down more. And so my point is, I'm trying to make it's not nearly as representative of the entire U.S. economy as is the S&P 500 or even the Dow, which is only 30 stocks, but it's more diversified as far as sector coverage within the economy. So there's QQQ, and then if I put on the trend lines, boom, beautiful bull market uptrend line, super well defined, comes off the 2008 lows. That's when the Nasdaq 100 bottom. But again, because it's different, it's not really as representative of the stock market as SPY or even the Dow or Wilshire 5000 index. So you had it bottom back in late 2008, but you also had a major reaction low in 2009, and then you can see lots of reactions along the way. And just like the 20-month, it came in, boom, we've recovered both. So QQQ may park the month still in above its bullish trend indicators. If you don't want to use the term bear market or bull market, let's just say the trend on this scale, this monthly time frame is bullish. However, these negative divergences tell me it's only a matter of time before they break down, most likely, no guarantees. Sooner or later, we know that. And it also tells me the scope of the upcoming bear market's going to be pretty darn nasty. So really where I'm going with this, guys, is I'm looking now, whereas in the last couple weeks I told you that SPY, on the upside I said it was poised to outperform. That's why we went long the financials on the bounce recently, and I said SPY will likely outperform QQQ, which it did, because they got beat down more on the way down, and they're still down more off the highs. QQQ is held up because it's tech companies and they don't have as big an impact when people stay in their homes. They're still using technology. They're still using their phones and computers. They're still shopping online, using cloud storage, things that don't require their physical presence, like a lot of retail stores that are in in other industries, hospitality, airlines, and all that are heavily in the S&P 500. So now we're going to look at everything else. I just wanted to tell you that and just take it for what it's worth. That's QQQ is still hanging in there technically, but now we look at every other index or sector or market, I should say. The S&P 500, there's your benefit of the doubt, last chance bull market trend line. There's the 20-month. You can see we're well below the 20-month. No chance of recovering the 20-month EMA by tomorrow. It's also done a great job at defining bull and bear trends in the S&P 500. You can see here. Bull market, bear market, bull market, bear market, bull market. A little more whipsaws. It works, does fit better a little bit on the Nasdaq 100, but still does a good job here. Well below it. This was really a trend line I was watching, this yellow trend line right here. I'm going to move it and wiggle it so you can see it, or I'll draw over it. And so really to me the bear market started, technically didn't start, but that's when the breakdown occurred back in the end of 2018. We broke below it and we were back testing that for a while and then rolled over and came very close to that was a long-standing bear market target, those 2014-15 highs. But point is, technically this one's broken down. It's on a sell signal, and it is, again, more important, it is the stock market. So and the negative divergences, like I said, tell me that this is just the start of much more to come, most likely. I hope I'm wrong for everybody's sake. I don't want to see a multi-year bear market in the economy. So we'll watch, see if this can prove to be a whipsaw signal. Maybe we're going to close a month below it tomorrow, almost certainly below the 20 period EMA. Probably that trend line, not definitively. We'll see where we're at. Here's Dow. There's a very clean, simple bull market trend line. I just overshot it a little bit in the 2009 lows, but it's nice and clean. You can see a lot of reactions there. You can also see that 20-month, and the Dow is well below that right now. So by just about all metrics in these divergences say bear market rally, early stage bear market action, look to short dips. That's the whole point I'm doing this video. That's why I start on the short-term stuff and then segued into the longer-term charts to kind of paint the bigger picture. There are no certainties. Is it possible for the Dow to jump back up there and regain all these levels and continue on and then go on to take out the divergences? Anything is possible. For anybody to tell you otherwise, they just they shouldn't, because that's how it is. What I do want to show you now is why QQQ looks better than everything else. Let's stick on these monthly charts and we'll run through this. Got enough time, a few minutes. I'm going to rifle through the 11 sectors. There are 11 sectors that make up the S&P 500. I'm I'm going through these in order their weightings. So keep that in mind that even if I don't get to the bottom few, XLK, last I looked, was about a 25% weighting, was over almost 25%, nearly one fourth of the returns of the S&P 500 are attributed solely to this sector. Everything else starts to go down quickly from there. And you get to the bottom when you're looking at basic materials, REITs, utilities, they do not move the needle. The REIT and utility sector could blow up right now. Every company could go away to zero. And that's not going to happen. It's not going to have nearly the impact that a big drop or rise in XLK was because of the weighting, because of the fact that Microsoft and Apple are over $1 trillion market caps. You're not going to find basic material and REITs and utility stocks that are in that club. So the impact on the market is tremendous. And so what I'm showing you here is XLK, the tech sector, as I said, led this bull market on the way up. And it was a lot higher when we topped, and it fell less than the S&P 500. And so far, you look here, there's my bull market trend line. Boom, a successful kiss and test, and back up above the 20-month. So tech is looking good now. However, it broke down. This was a bearish rising wedge. There was a divergent high that had been building for a while, and so I think there's more downside to come. I feel pretty confident of that, and I think ultimately this line goes. And I think at some point soon we may see tech actually outperform to the downside, and that's what's gone into my thinking here with adding QQQ this time around instead of the financials or SPY, as well as shorting the semis today, because so far, yes, the impact on these guys to coronavirus, not as much. The impact to these guys during the next recession or downturn in the economy will certainly impact things. These guys run at higher P ratios, inventory levels. I'm going to get to the semis here in a second too. I know long video, but I've been wanting to get all this stuff out to you guys. That's it. So tech for now is okay, and that's why QQQ looks okay, because as I often say, QQQ, I jokingly say, is just basically XLK with an Amazon kicker. Why do I say that? Well, Amazon's not a tech company. It's a retailer. Yes, they do their stuff online, but it's not in XLK, the tech sector. But it has such a huge weighting in the Nasdaq 100. That it's going to certainly impact it. But either way, that's what we're looking at here. We'll watch tech. And I'm going to get to the semis in a second, because the semis are a subsector of tech, and they are, for the most part, the canary in the coal mine for the entire tech sector. Now, as I go through the charts, I showed you tech's okay. And again, being the largest sector in the S&P 500, that means, hey, things are, okay now from that perspective, that one sector. But if tech breaks and really starts heading down, that's going to add more pain to the S&P 500, which has already felt a lot of pain due to the financials, airlines, and everything else that's in there. XLV, done. I had two trend lines here. The yellow one is the benefit of the doubt. I had this white trend line right here, which we broke down like so many sectors. This is where I think everything started back in late 2018. We back tested and then rolled over. That's back testing. All the while we've been building negative divergence for a long time in XLV. Again, the healthcare sector, second largest in the S&P 500. And then, as I like to do, if I can draw two trend lines, I'll do so. And I'll give the lower one, I'll call it the benefit of the doubt trend line, because you need to see that trend line break. And wait, give it the benefit of the doubt for as far as the sell signal goes. We are poised to close below it. In fact, we will almost certainly close below it. Right now, we closed today at 88.97. That's the bottom of that red candle. We'd have to pop about 4%. Now, we could get there even if it's a 3% pop tomorrow. We could close right about on the trend line. Then you'd, again, want to give it the benefit of the doubt, say you're close enough. But we're in a precarious position. It's poised to print its first monthly close below the uptrend line, the BOD trend line, in a while. And as you can see, I zoom in, there's that 20-month EMA. Look at all these stick saves here where you closed right, hit it and then close right back above it. You flirted with it back here. I'll give you that back in 2016, and maybe that'll be possible. Maybe that's possible here. But you know what was different back then? See this? We didn't have negative divergence leading up into that high in 2015, 2016, and we do now. So there's XLV, bearish technical posture right now. XLF, done. That thing broke down. Let's not even spend time talking. There's your trend line right there. The financials melted down too much in '09, so that trend line, you can't draw a clean trend line off there. It was more of a kind of like a capitulation final meltdown. If you want to draw it, would draw this one. And then you broke down in late 2018, like a lot of sectors I said, and back tested. Either way, they're both done. That's your benefit of the doubt trend line. Already hit that bear market target there of the 2015, 2016 highs, and we got to bounce out of it. But this is a big, powerful sell signal, and it looks to me this is usually not a one and done type thing where you just rally on and cheerio, everything's good, we're off to new highs again. That's more indicative of the start of a much larger drop to come, but we'll see what happens. But anyways, so far what I've done here is gave we'll call it a soft check mark. We'll check mark to XLK, the tech sector. Healthcare and financials, they're done. They broke down. XLC, it's a new sector, so we don't have a lot of charting history to go off of. That's the old telecom sector. They now call it the communications services sector. Broke down, hit the support. I pointed that out recently. We were at that support level. Mentioned that as a likely bounce candidate. We did. We bounced. And how far do we bounce now? That's the thing. And we can put up fibs on here, Fibonacci retracement levels, and show you so far that these are nothing more than just typical run-of-the-mill counter-trend bounces. As powerful as they are, they haven't done anything to say that they're anything more than just. In fact, when you look at it this way on XLC, like a lot of sectors, this is only the first counter-trend rally. I mean, in trading, investing, you have at least an ABC wave and a corrective wave. A being the first leg down, B being the first bounce up, and then another C wave down. That would be, a typical corrective wave right there. And we don't even have that yet. We have just what is the makings of maybe a B with another C leg down to come. I'll just do two or three more and stop here. XLY, there's your trend line, bearish rising wedge. Again, we're on a monthly chart. This is talking long-term, bigger picture stuff. There's your breakdown. No chance of recovering that trend line or the 20-month EMA by tomorrow. That's a foregone conclusion. It's too far below. XLY, perfect tag of those highs. Again, that's levels I've been targeting since before the bear market even started for the next bear market, which we're now in, and that's again those late 2014, 2015, and early 2016 highs right there was a major level to target, and that was kissed by so many sectors recently where they bounced. So again, to me, it looks like just the typical reaction, which the charts were indicating, and then maybe and we've already bounced quite a bit up. We could go up a little more, but there's probably more downside to come. I just wanted to mention there's another sector I'd put an X because that one has broken down now, triggered a long-term sell signal here. XLI Industrials, done. That's a solid breakdown. Went to the bottom of that trading range from 2015 to 2016. Nice bounce since, but pretty much at or near that former support right there, this level here, and I'll bet you we probably close there tomorrow is my guess, right around that 58.41-ish level. So same thing, negative divergence, all this stuff that had been building for a while, and they're just now starting to play out. XLP, consumer staples, there's your support level. Bottom of that support zone was hit. Nice bounce there. XLE done. Let's just leave it here. The energy sector is done, and this is also why the banks are screwed. They have a lot of money out to the loans out to the energy sector, the loans that they're never going to recover. A lot of companies will go to the wayside with oil. There's no way a large percentage of these energy stocks, these drillers, energy companies can sustain such low oil prices. So there's going to be repercussions to come there. So also a reason why we're short LQD again. Again, there's pain to come there, and you'll get powerful bear market rallies when you're so beat down. But it's just a broken chart. And last but not least, I won't go into detail, but here's SOX. This is a semiconductor sector index ETF fund. It tracks the same index. It's SOXX. The PhilX SOX, here we'll pull that up, SOX, on TC2000 or free stock charts, you do SOX and then two dashes there plus an X, and that's the same index. So this one's been around forever. That's why I like to use it. There's two other main, fairly liquid semiconductor ETFs, but they track different indexes. I like to use this one for tracking purposes. You can see all the bull and bear markets. You can see the trend lines that define the bull and bear markets, and you can see just recently we hit our secular or larger cyclical bull market, I should say, uptrend line right here off the 2008 lows. Remember, tech, just like QQQ, remember in the beginning, no coincidence, they bottomed in the fall of 2008. Everything else, the rest of the stock market, or the stock market, I should say, bottomed back in March of 09. Beautiful, clean uptrend line. There's your bull market uptrend line, and nice support. It's the level I've had on this chart for a while. I've shared this in many videos over the past couple of years. About 1230 on SOX. So we hit just recently dual support levels, your bull market uptrend line, as well as that nice price support level was the highs back from the dot-com bubble. Took the semis all those years to get back above there, and we broke out, and that's a very significant level. So now let's go to the ETF. Same trend line. Remember, it's tracking the same sector, and now you can see here you have these uptrend lines, right? You go back. For the most part, we've been in a secular bull market. This was sort of a sideways market for years here, but the strong bull started back in late 2009. And you can see that these trend lines, look how well this sector acts, or behaves, I should say, to the technicals. You draw these nice clean up trend lines, and then you get a break, and it may not look like much. We're looking at a chart here on log scaling. Let me just measure it out and show you kind of what these drops are when this sector finally turns, when the momentum shifts and you get the sell signal via the break-free trend lines. There's 38%. I'm doing rough numbers, 25%. There's a breakdown there. It was good for 25%. Here's one there that was 33%. There's one here in 2015 that was good for about 30%. Trend line break and back test right here, and that was good from the high to the lows of about 26%. And remember what I'm telling you here, this is very important. These are all just corrections within a bull market, and that's why that whole 20% bear market definition doesn't work for volatile securities, volatile sectors. All these drops were over 20%, as I just showed you, but they were just simply corrections in an ongoing bull market, which has run from the late 2008 up to the highs. Posted gains of over 1,000, about 1,100% there. So now, where do we go from here? We already fell. We kissed that trend line support. Possible it holds, but I doubt it. We broke this minor trend line. And this was a bearish rising wedge. All these other little corrections within this bull market, what made them different from this one is they didn't have negative divergence. We're looking here at the monthly chart. We've been diverging for a while. So this tells me that this is likely the shot across the bow, and ultimately going to break this longer term bull market trend line. And the semis could and will most likely have a lot to fall. Wouldn't surprise me in the least. I'll tell you right now, certainly target the 2018 lows, certainly or quite possibly target those 2015, 2016 highs, somewhere in there. So I'm leaving this one open for potential runner trade. And then finally, okay, Randy, you painted the big picture, right? Maybe those divergences play out. Maybe there's a big bear market coming. So what about the timing of this trade? So as I mentioned today, this 218 is a big level right here, and we didn't get there yet. And as I said in the trade today, that I think you can scale in. I think there's maybe 5 to 6% upside from where we shorted today. 218 is a big level. We had a divergent high right here. We failed at that level once. Correction. Ran up, hit it again, correction. Ran up, hit it again, correction. So that's 1, 2, 3 failed attempts. Finally, we broke out. Yay, that's a check mark. That's bullish. Ran up there. However, came back tested it here after this correction, and it failed. So that level's been checked. In other words, there's numerous reactions on that level on around 218. In addition, you have that beautiful 200-day exponential moving average right near. We're looking at it. This is a weekly chart, so it's a 40 period exponential moving average, and it does a great job, especially on tech stocks and sectors. When you're in a choppy market, moving averages don't work well. In a trending market, that's when you want to use them. So during an uptrend, you're above the 40 week, as you were here. You broke it right there, boom. That was several months, and a correction measured in from when it broke, the semis fell 19%. So you can't call that a whipsaw signal. That was several months of trading, about 6 months before it recovered it, and then it got back above and it's acted as support, and we're below it. So what do I see? I see not only a breakdown with this divergent high, trend line break, so there's the confirmation there, but I see us coming to back test that 40-week from above with 218 just below that. So that's my I feel very good about this trade. Doesn't guarantee it'll work out, but like I said, the risk, the upside loss potential is only about 6% from where we are. And if we reverse, which I do believe we do, we go down here. I would expect these lows at minimum to be taken out. If we get back down to that low from just a couple weeks ago, you're talking 20%. And if we get down here to that next target there, that's about 144. That's the lows from 2018 and some other resistance. So you're talking, where was I? About 31%. And then ultimately, before all said and done, I think the semis will head down here to that's the highs from back there in 2015, 2016. So we're looking at potential, not including the leverage. This is just on the, if you use without using leverage, about a 50% drop in the semiconductors. And again, history shows that when this sector corrects, it can easily do, especially in a bear market, 50% or more. We'll go back to, let me tell you what it did in the last bear market here. Turn off all the lines so I can measure for you. There was our high right before the market peaked in 2007, and the semis fell about 70%. So that's typical bear market stuff for these guys. They're much more volatile. Their industry is very cyclical in nature. When you get inventory buildups, when everything's good and you're at the height of a cycle like this, they're pumping chips out like candy, just one after another, and all of a sudden, especially with what's going on now, the economy came to an abrupt halt, a screeching halt. Never before, the global economy, never before seen in history. So the question right now, nobody's asking, is there going to be a recession? That's a foregone conclusion, even though it's not yet and won't be official for a while. The question is, how bad is the recession going to be? So right now, while all the focus is on banks and other things that are on the verge of, they're melting down, or just a few bad days away from that, I think everyone's thinking, okay, tech's untouched, it's unscathed, tech will be fine. No, tech won't be fine. If we're going into a global recession and there's more to come, tech will start feeling the pain soon. And who's going to feel it worse than just overall QQQ or XLK? It will be the semiconductors. So therefore, it's a higher beta trade, a little more aggressive, and it's certainly an overlap to the QQQ short trade, but one that again, I think has a lot of potential. If I'm wrong and they run us up through our stop and go much above that 40-week and the 218, 220-ish level, where do they go? Well, it's certainly still going to be well off the highs, and you have a trend line to be back tested, although I really doubt we're going to get up that high. If we do and we're stopped out, I will revisit it, and we'll see how the charts look at that time. But as of now, this is what I'm leaning towards here. All right, we're going to wrap it up here. Long video again, but I covered a lot in here, and hopefully the bigger picture part that I tried to paint helps clarify my thinking, my short-term thinking, when I can go, and want to short or, add a short position like I did on a day like today where the market's rallying strong, especially after it's been rallying for a few weeks here. Again, I'm looking at, if it is a bear market, where to start adding back the next short exposure, because I don't want to short stocks once it's fallen down to here and everyone says, okay, that's time to short it. I want to short when no one else wants to short it. And I'd rather get in a fast-moving market like this a little early than a little late, because a little late in this market, when it turns, it could be very, very fast. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.